Hello, I'm Tammy Green, and welcome to this week's edition of Your Week in Forex with your favorite Forex broker, UFXBank. This week, John Gibbons is with us to review last week's market highlights. Germany has sparked uncertainty and risk aversion by putting a ban on naked short selling of some financial assets. The euro crisis is continuing, but there is no major news out this week. Stocks are continuing to decline, and we are seeing risk aversion and risk appetite growing. The euro has hit a 4-year low against the dollar, and Merkel is advising that the euro is in danger. Now let's go to John Gibbons, financial analyst, for a closer look. Welcome, John.
Thanks, Tammy.
So what was the outcome of Germany banning the naked short selling of some securities?
Well, this sparked uncertainty and a brand new wave of risk aversion flooded the market, which helped to raise the dollar and the yen. This ban also triggered anxiety about whether we'll see more regulation of this sort and other countries follow Germany's example. Comments by German Chancellor Angela Merkel that the euro was in danger further undermined confidence in the single currency. And remember that the backdrop for this announcement is a very neurotic market, which is inclined to give any euro-related news a negative spin, at this time, of course. And we have seen standard risk aversion in the movement of the dollar and the yen. The euro has fallen about 15% against the dollar so far this year, hammered by concerns, Europe's debt problems and austerity measures to combat them. This could hamper the eurozone's economic recovery.
Can you quickly define for us what naked short selling is?
Sure. Naked short selling involves selling a financial instrument without first borrowing it or ensuring it can be borrowed.
What do you think Germany's decision says right now about the future of the Eurozone?
Well, it's become crystal clear at this point that although it is called the European Union, these are still separate countries with their own political agendas. This actually, I believe, is at the root of the nervousness that was felt last week over Germany's announcement. Germany also appeared to catch its Eurozone partners off guard as well. Germany's curb on speculative trading has cast a huge cloud of doubt on Europe's ability to build the sort of economic governance that many believe is now essential for the euro's survival. The move stunned France and showed how the Eurozone's two largest economies, Germany and France, are struggling to coordinate policy during the debt crisis that has engulfed the single currency. France and Germany will have to start speaking the same economic language, or else the euro will disintegrate.
What was France's response to Germany other than just being stunned?
French President Nicolas Sarkozy has said repeatedly since the start of the Greek debt disaster that Eurozone countries must now establish common economic standards and practices if they want their currency to flourish. But the very concept has revealed core differences between Paris and Berlin. France talking about economic government, which sends a shiver down German spines, and Berlin preferring to talk about economic governance. The word government gives the impression of an outside body that would dictate economic policy, whereas governance raises the prospect in German minds of creating structures, framework, and sanctions.
What are the main economic discrepancies between Germany and France?
Germany has undergone painful reforms to create a lean, efficient export machine that is creating unsustainable imbalances across the Eurozone. While Germany is ratcheting up seamlessly endless trade surpluses, many of its neighbors, including France, are building up multi-billion euro deficits. The answer for Paris is that Germany should boost domestic demand and cut taxes to encourage imports. For Berlin, the answer lies outside its borders. Other countries should simply copy it, primarily by lowering wages.
Could you give us some technicals for this week?
Sure. Let's discuss the Aussie dollar. The Aussie dollar has broken through layers of support to confirm a top on a break and hold just below that point its August 2009 low of 81.55. This low will be targeted ahead of its strong level at 80. We expect this level to contain its current declines on initial testing and thus push the pair back up and possibly trigger a corrective recovery. Its RSI range is bearish and pointing lower, which is in support of this view. Alternatively, the pair will have to break and close above the 85 and 85.76 levels to clear the way for a recovery towards the 87.04 level, followed by the 90.77 level, which is its May 2010 high. The Aussie dollar has a lot of overhead resistance to overcome if it stages a corrective recovery.
Well, thank you, John. It was a pleasure having you with us this week. Until next time, I'm Tammy, and this is your Week in Forex. Don't forget to visit us at UFXBank.com for simple, safe, and secure trading.